let's finish up U.S. versus non-U.S. There's a lot of reading you can do here. We talked about the ease of doing business, that index. Essentially, what you're looking for there is not just the firms that are doing, or the countries that are doing well. You want to see the countries that are improving, getting better. I like this book by Jim Rogers. I like Jim Rogers. Boy, I think he's trying to generate interest, so he says outlandish things on purpose. But he's a really smart person. He really has a good experience. But yeah, he does say crazy stuff, and you'll see if you Google his name. But he wrote a book called Street Smarts. His whole thing is Asia, the Asian tigers. He thinks Asia is the future, and that's where you need to invest. He believed it so much that he moved his whole family to China. And then he was in a place where there's a lot of pollution. He couldn't take that. So they moved to Singapore. But both of his daughters are fluent in Mandarin and English. So, he put his money where his mouth is. That's where he thought the future is going to be. And so he went for it. I really like this book, but boys, it's a tedious read. You got to get through it. But Why Nations Fell. But you as an investor, what they did is they have a theory for why some countries take off and do extremely well, and other countries have a start, looks like they're doing well, and then they fizz out. So Argentina is a good example. They talk about Argentina. Argentina was one of the wealthiest countries the first part of the last century, and then everything just fell apart. And they asked the question, what is it? Is it because they have a coastline? Is it because they have natural resources? Is it culture? What is it? And they go through their theory, and they give you a theory that gives you a way of thinking about a country that you're trying to look for breaking out. Should you be in South Africa right now? Should you be in South Korea? And he talks about what are those things you look at. Africa, the biggest issue with Africa right now are the landlocked countries versus the non-landlocked and infrastructure between them. So those kind of things you're looking for. I think the challenge with that book is the theory is really, really good. It's really interesting. But then they try to prove that it's right by giving you 100 examples. And they go through so many examples, you're like, enough already. I think I got it. But it is interesting. They go back several centuries as well. If you don't like that, then this is a podcast or a video. The great courses. I like the great courses. I think they're ridiculously expensive, what they charge, but they are very, very good. He teaches a class, and a student of mine recommended this class to me, so I watched it, and I was thinking, boy, he's read this book. And sure enough, this book is a big part of his class. He essentially read this book and created a class out of it. So if you rather do a video, and you don't have to really even watch it, you can just do it audible, that would be a good one to do as well. This guy, I would look him up. He's written some books. He's at Morgan Stanley, or he was. So here's these books. So the Chalmers, he has the 4 Ds for global investors. So his 4 Ds are depopulation. Why does he say that? Because most of the free world, and even most of the world, has a replacement rate that's too low. We're not having enough babies, so the world's shrinking. So depopulation, what does it mean that we're going to hit 10 billion people and not go any higher, and maybe even start coming down? You've seen that in countries like Japan, but you're also seeing it even, we think of the U.S., but the U.S. is actually doing better than a lot of the rest of the world. So China is in the same issue. The second one is deglobalization. We've had a globalization. He says it's going to start reversing. There's going to be more nationalism. Countries like Germany are going to be really, really harmed. Countries that really rely on exports, they're going to be harmed in this environment. Deleveraging, we have all these countries with government debt that's just out several standard deviations. How's the U.S. going to pay off all this debt that they have? How's Japan? Japan has a horrendous debt issue. And then the last one, which is the scariest, is de-democratization. They take surveys in South America of their views of democracy, and it's just frightening how negative population. Isn't that scary? The populations are like, we don't like democracy. We'd rather have a dictator, be a lot safer. They're looking at China with President Xi, and they say, well, that looks a lot better than what we have. It's like, isn't it? That's kind of scary, isn't it? So what does that mean? We're having those debates in the US as well. People are using, both sides are really debating that hard. So he's saying there's some things going on. The rise and fall of nations, forces of change in the post-crisis world. I read his book, but I don't remember if it was that one. But he's an international manager, so he's writing this not from a gee whiz standpoint. He's writing this as an investor. How do investors should think about this? So I'm sure he could buy. This is a podcast. Barry Whitholtz, he does his podcast and he interviewed him. So you could find this podcast. He did it 6 years ago, or you can buy his books. So really, for international, there's just so many angles. There's so many countries. There's developed, emerging, frontier. There's so many different ways you can go. You just read and read and read and read, and you're looking for some insight that gives you some edge over others. So he's someone to read. And this is a good example of what kind of reading you should do, is find those large and portfolio managers that manage billions of dollars in international money and see what they're publishing, what articles are they writing, what books are they writing. And so here's a good example of someone who does that. All right, so that's it for stocks. So someone tell me, what's the bucks? The B
versus Non-U.S.
What's the first one?
Beta.
Beta.
Consolidation.
Stock. All right. So beta, which is, should you be in stocks or not? And then if you're in stocks, do you want cyclical or defensive? US versus non-US, what's going to drive that? Well, it's the economies of the countries and currencies. On the exam, you got to talk about those two things, and I'll give them on the exam. So right now, you might love the Japanese stock market, but what would be the big killer for the Japanese stock market? The yen. So the stock market might be doing well in yen, but when you buy it and you're a US investor, anything you make on the stock market, you're going to lose when you convert it back to US dollars because the yen has done so badly. So US versus non-US, you have to really worry about currencies as well as the economy there. Capitalization, recession, small companies aren't going to do well. A recovery, small companies going to do well. And style, growth do better in weak times. Value does better in strong times. Right now, we have no clue because growth doesn't like higher interest rates. Value doesn't like recessions. Right now, we have higher interest rates and a fear of a recession. So it's like flip a coin. Who knows? I've been loading up on value, but right now everything's down. But value has done better than growth, but still. All right. So let's get into alternatives. So alternatives, it's really everything else that you could think of as an investment, and we'll limit our discussion here to the major ones. I gotta watch the time here. No clock is right here. That clock's 15 minutes off. All right, so the main thing for alternative is usually the main driver is diversification. You want something like gold that's going to be diversified. It hasn't worked this year, has it? But in 2008, gold was up a bunch. Everything else was down. So we'll talk about these. The other thing with alternatives is we're going to put real assets under alternatives. Real assets generally do well in inflationary times. In fact, real assets may be driving inflation. I have a friend trying to move back to San Antonio with his family, and he's like, I can't find any place to move. Everything's too expensive. Rents, are y'all's rents going up? Are y'all noticing it? What about the dorms here? The dorm rents are going up. Is it pretty material? Like 20%, or is it pretty mild?
Growth have been going on pretty much.
Yeah.
Growth are going off pretty much.
So, and that's a real estate related assets. So is it a hedge? We certainly have seen energy prices go up, although the oil has come back down here recently. So diversification and a hedge for inflation if it's a real asset. So that's what alternatives are. So we're going to separate it between real assets, and then we're going to do private equity. There's a lot of other assets out there. Real assets, boy, if you think about it, I'm just not scratching. One of the most popular right now, I may not have even heard of this one, is infrastructure. Y'all think of infrastructure as a real asset? So what would infrastructure be? So a toll road. You know, you can invest in a toll road. Real popular in Texas now. Aren't you glad we don't have them in San Antonio? Any of y'all from Dallas and Houston? I find it really stressful going to those cities because I don't know how toll roads work. I finally learned how to do text dot whatever on my phone, so at least I don't get charged, 50% more. But it's stressful to me. I'm really glad they shut down the toll booths. That's really good because that was stressful for me. I was like, do I need cash? Can I use a credit card? What am I doing? I'm just like panicking because I don't use toll roads. But you can actually invest. Governments are selling off their assets, and that's a whole investment class. So catastrophe bonds, I talked about that in my property and casualty. You could invest in a bond that's tied to hurricanes. I should go look those bonds up right now because they're probably not doing well with the hurricane hitting Florida. But you have bonds that pay a really high return unless there's a major hurricane, and then you lose a lot of money. Crazy, crazy stuff. So we're getting creative here, the type of assets that you can have. But we're going to hit the major ones. So real assets, and then we're going to do private equity or venture capital. There's only two we're going to do. But realize there's a bunch of others out there. So the real assets we're going to do are real estate, timber, and commodities. Those are the three we're going to do. Real estate, timber, commodities. So real estate, you know what that is. It's buildings. Could be commercial real estate, could be residential. We're going to focus on commercial. I used to say that's because investment markets don't deal in residential, they only do commercial, but that's definitely not true anymore. The investment world, BlackRock and some of these other large firms have been buying a lot of residential. In fact, it's kind of shocking how much they own now. It's really maybe one of the reasons rents are going up so much, because you have this concentration of power. But we're going to ignore residential just because that's not my background. I can't really tell you what's going on with these markets. But real estate, the expected return on real estate is really, really tough. But most people think real estate is somewhere between stocks and bonds. If stocks are going to make 8%, bonds are going to make 4%, real estate's like it's 6%. Somewhere in between that. Same thing with risk. If stocks are high risk and bonds are low risk, real estate's somewhere in between. But we really don't know. And the reason we don't know is we don't have good data. So if I want to sell my Apple stock today, how hard would that be? Well, the market's closed. But tomorrow, how long would it take me to do that? A few seconds. I click sell and I go check on my trade, and it's already happened. It happened within a millisecond. If I want to sell my condo today, how hard would that be? If I call up my broker, say, I want to sell my condo, and she says, yeah, fine, and I want to sell it today. She's going to say, what, are you crazy? How many days do we go by where there's no Apple stock sold or bought? When's the last time that happened? Probably not ever. When's the last time a piece of real estate wasn't sold? Probably 90% of the time, 99% of the time. So that's the problem with real estate. It doesn't trade like stocks do. We don't have a price every single day. We might have a price of a building that was sold down the street, but that building might be 8,000 square foot and my building's 3,000 square foot. That one might be right on the corner of 604. Mine might be inside a neighborhood. It's hard to find apples and oranges on real estate. It's all different. So what we have with real estate is something called appraisal smoothing. Most real estate prices that we have are appraised values. They're not actual transactions. And so when you look at a return on real estate, we have them. NCREIF gives us returns on real estate, but they're returns that are driven mainly by appraisals. And appraisals are much, much smoother than actual real life prices. This is something we study a lot at USA because USA has a massive real estate portfolio, very unusual. very few property and casualty insurance companies have large real estate portfolios. USAA is probably the outlier. Most property and casualty companies do not have any real estate at all. A few have maybe 4 or 5%. USAA just massive real estate portfolio. And so one of the things the team I was on, we had to come up with is the assumptions. What do we assume for real estate? We read a lot of articles, and it was really hard to come up with a good assumption on what real estate was, what good returns you could have. The other problem we had is NCREIF. They publish returns, but they publish quarterly returns, not monthly returns, and definitely not daily returns. So I got the stock market and bond market with monthly data. NCREIF is quarterly data, so even then it's going to be much smoother. If I use NCREIF's numbers for my return and risk, the return numbers are probably about right. Because if they got one quarter wrong and another quarter wrong, it's going to balance out over time. But the volatility is going to be way off. Real estate's going to look much lower risk than it truly is. And so you have to make some kind of adjustment. We tried all kinds of things. But it's just, you just have to eventually just guess on a number, what you think real estate is. And that's what we came up with. Somewhere between stocks and bonds on return, somewhere between stocks and bonds on risk. So real estate's a very, very illiquid asset, which means it doesn't trade all that much. And it's very unique. No two pieces of real estate are really the same. I learned that selling my mom's house, trying to get an appraisal. I paid for an appraisal. And the range was anywhere from like 470 to 610. Like, thanks a lot. That really helps me a lot. 470, 610. So yeah, I guess it's 610. I'll sell it for 610. Who knows? Why? Because I couldn't find a house that was just like, even if I could find a similar house, it may be a similar house that has a brand new fence and a brand new roof. Well, I can price how much to put a new roof on, but what I don't know is I put a new roof on and that cost me $20,000. How much does that add to the value of the house? It might add 30,000 to the value, so there's all these uncertainties. One house had a pool, all these kind of things. So it's really, really tough to do. But we do our best with appraisals. Appraisers, they know what they're doing. It's a skill. They're trained to do it. They know how to do the analysis, but it's still a guess. Same way people who value Apple stock, we know what we're doing in finance. But if you have people value Apple stock, you can get values all over the place, from $100 to $250. It's going to be really a wide range. So even with stocks, it's tough. But with stocks, at least we get a market value all the time, all day long. With real estate, we don't get much. Now, when we look at commercial real estate, we tend to break it up between geography and property type. So let's go to NCREIF. I can't, let's see, NCREIF.org. I always forget if it's .com or .org. So of course, big buildings. This is what we love about real estate. We have nice glossies. I don't know what city, it looks like Chicago maybe, I don't know. But anyway, it's the leading provider of indices. So that was an indice. They give you returns. So it's a famous, they used to give their return on their website for free. Guess what? They don't do that anymore. So now you have to pay them. I don't think they do unless they've changed their website. So there's their MPI. So if you want to pay them money or whatever, you have to sign up. So, but we used to be able to get this for free, but you get quarterly data. I forget how far back it goes. I think back to the 70s. So it's a pretty good collection of data that you can go back on. They do have research. So if you're interviewing with a firm, then you might look at their research and see what they have. Institutional real estate returns. What I mean by institutional, that's the big investors, like the pension plans and the insurance companies. Returns declining, but above historical average. Record price appreciation. Well, there's two articles that say almost the exact opposite. Why? Because one's in February and one's in August. Strong performance continues for MPI first quarter. That's pretty old. Highest return in 15 years. So what do you notice? As you get closer to the current, it's getting more negative. Why? Because mortgage rates are up, interest rates are up, and commercial real estate tends to have a lot of debt. So it's just the nature of the, so it's a good site. It's the kind of thing you should be reading. So geographies. So geography in the US, you have the Northeast, the Southeast, Midwest, the South, the Northwest. I mean, the Northwest, the Northeast. I think I said that right. But anyway, you got East and West, North and South. You got the mid side, which is Chicago and all of that. Texas is a little tricky where it goes. Is Texas South or is Texas West? So you have to see how to define it. But they do break it up. Why? Because they're very different markets. Texas is more energy driven, oil driven. New York is more finance. California is more ag and and tech. So they're different markets. So they have different things driving them. And then property tax type. Hotels, office. How did hotels do the last 3 years? Do you wish you had a major hotel property in 2019? Probably. I went to the hotel I always use in New York because it's cheap and it's perfectly situated. It's the only place you can get like a $200, $300 a night hotel in New York. And I showed up and like, where have you been last 3 years? Like, yeah, and they had completely shut down. They weren't renting anything out. They almost went under. They said, we almost went under. I said, you haven't been here since COVID. And they said, yeah, last time you were here was in 2019. I said, yeah, good reason I haven't been back. So hotel, office, how about office since COVID? People working from home, that's a major issue. Retail, more online, but retail is doing well in some places. Industrial has been the place to be. Why? Because Amazon's building all these massive industrial parks. And so industrial's done really, really well. Apartment, probably doing really well right now because of low vacancies and high rental rates. They're probably doing pretty well. How are malls doing? Probably the worst case scenario of all of them. They were doing horribly going into COVID, and in COVID just really wiped them out. I think the only people in malls right now are 80-year-old people and people in tennis shoes walking the halls. They're not buying anything. So malls are dying. But there are some malls doing well. The outdoor malls like Lock and Terror are doing great. Some are dying and shutting down. So if you do real estate, you're definitely going to have some understanding in geography and property type. USAA was heavy into hotels, heavy into industrial. That's why USA's portfolio has done so well. They're heavy in industrials, and I was shocked at some of the things. They did a lot of build to suits, and it was just incredible how much money they're making off of those. I didn't understand it. I didn't understand why Amazon paid USAA to build their industrial complex and then gave USAA this massive return for doing it. Why Amazon just didn't do it themselves, but they're making a fortune off of that. USAA did almost no apartments, no malls. They had some retail, but more hotel, office, industrial, but mainly hotel and industrial. I don't know how their hotels are done, but one of their hotels is La Cantera. Probably didn't do well under COVID, but it's a hotel that's in a good location. Any of y'all real estate majors here? Always get them in this class. If you are, get to me fast, because all my contacts at USA Real Estate are retiring. They're all old like me. So in a couple of years, I won't know anybody there. I won't be able to help you at all. But everybody's getting old. I guess my name contacts are going to be UTSA alums. They won't be people I work with, which is good. We have a few UTSA alums at the real estate company. All right, so there's commercial real estate. And then the market said, the stock market said, hey, we can play in this game. We want to do real estate. So they created something called real estate investment trusts. They also have real estate operating companies. But REITs, have y'all heard of REITs? So what is a REIT? So REIT was created by the tax code. And what a real estate investment trust is, it's a trust, or essentially a mutual fund that owns real estate. But as long as they pay out a certain percentage of their income as dividends, they're tax-free. So they don't have to pay any tax. So it's kind of an advantage for REITs. They don't have to pay tax as long as they pay out certain income. Real estate operating companies are not REITs. They don't have that advantage, but REITs have that advantage. And so what they're trying to do is take this really illiquid asset, real estate, and make it liquid by having a stock trade. So it trades just like a stock. So it's a stock, but the underlying assets are real estate. And the tax code requires it to be real estate because the tax code tells it has to have a certain percentage of its income has to be real estate related, and then they have to distribute that. So is that a solution? And unfortunately, it isn't a solution. Because a real estate investment trust does not look like real estate. Real estate investment trust stocks look like small cap stocks that have the return and the risk and the correlation to small cap stocks. Now, this is a big issue because I know some people who have, I actually had a mutual fund I inherited that was 25% in REITs. Unfortunately, when I got it, they had fixed that. But it was a crazy fund. Crazy. Boy, if I had inherited it before they fixed it, it would have been a disaster. But fortunately, they fixed it before I got it. But before I got it, it was 25% stocks, 25% REITs, 25% bonds, 25% gold. That is insanity. First of all, gold is really volatile. So 25% was in something that was just crazy. And you know, gold did horribly for like 20 years. And then 20% in REITs, they're thinking REITs for diversification in real estate. But REITs is nothing but a sector of small cap companies, very volatile. Did not give them that diversification at all because it's highly correlated. Horrible fund. It just blew up. Terrible, terrible fund. But it blew up before I got it, so I was kind of lucky. But you see their logic. It was well diversified. You got gold for inflation. You got REITs for the real estate. But that's not the way it behaved at all. It was just a crazy fund. And so the problem is REITs, they may own real estate, but especially their volatility looks like a small company because most REITs are small companies. And so, yeah, you're just not getting that advantage. Anytime you take an illiquid asset and try to make it liquid, its volatility is going to go up and its correlation to stocks is going to go up. People have tried to do this private equity. We're going to talk about private equity. Private equity is very illiquid. Very hard to know returns because the returns are there. Can we stick a lot of private equity into a mutual fund or into a trust and make a stock out of it? It doesn't work. It's going to get much more volatile and it just changes the whole characteristic of it. So there is a great website. I don't know what this says default at the end, but just REIT.com. And what do you think is going to be the main picture there? Bunch of real estate, you would think. Real estate people, they're real proud of their real estate. This one is .com, sure enough. So real estate people, every presentation they do, they got these beautiful fancy buildings. That's just the nature of what they do. It just looks like that. Now we're going to talk about timber. What do you think timber is going to have a picture of? You think you have a bunch of green trees or going to have a bunch of dead trees laying chopped down? Which do you think is their entry? Beautiful green trees or chopped down trees? What would you do if you're worried about your image? I would have beautiful forest. We'll see. We'll look at it. We'll see. What's a REIT? Investing in REITs, REIT data. They probably do have some pretty good REIT data, but you can get that a lot of other places. REIT indices. The NAREIT is not the best indices, but is a fairly decent indice. News, events. So there's all kinds of stuff. Now they hired Ibbotson Associates several years ago. And their argument was, you know, REITs used to look like small company stocks, but look, they now look like real estate. And they hired Ibbotson to go around. We met with them, and sure enough, REIT stocks, their correlation to returns will look a lot more like real estate. Exactly right. We're saying, wow, this is really interesting. So I went out and I did an analysis, and they're exactly right. For about 3 years, REITs looked a lot more like real estate. And as soon as they stopped their study, REITs went back looking just like small cap stocks. So they found this one period of time where REITs kind of looked good again, and then right after that, they went back to their old self. They got a lot of mileage out of that. Look at that. They got ESG right there at the top of their website. I can't get back to that. I don't know where that was. But obviously ESG is a big issue on real estate. You're talking about green buildings and all that kind of stuff. So so there's a lot you can do there with REITs. There are stock investors that all they do is REITs. That's their expertise. That's their specialty. They know real estate and they know stock markets. But REITs are not an alternative. We put REITs under small cap stocks for the most part. That's just where they belong. So if you get this in discussion, someone says, well, alternatives, that's real estate. Oh, and they say, oh, you mean like REITs? You now have a very sophisticated argument to say, well, REITs, yeah, they own real estate, but their risk and their correlation look more like small company stocks. It's going to be a really very, very sophisticated answer. I'm not going to cover real estate. That's residential, but I probably need to figure that out now. Who is the largest one out there? Investors bought nearly a third of all homes in Texas last year. And by investors, they're talking institutional investors. And impact of institutional buyers and home sales and single family. This is a very new phenomenon. Let's see if they show who the biggest investors are. I don't know if they show it. Key findings. So I'm going to change this, the largest institution resident. I don't know how to spell the word institutional, but we're the biggest investors in real estate. Yeah, that's not residential real estate, that's real estate. Here we go. Maybe they'll tell us here. I'll have to find it. There's 2 or 3 that are really, really massive in this market. And I mean, you think of Zillow, right? And they've had some serious problems here recently by just getting overextended. But there's some others like BlackRock and those type of firms that are just massive. They have trillions of dollars in assets. And they're really seeing residential real estate as a good investment. And it sounds like they still think so. I was reading an article not too long ago that they're not turned off by higher mortgage rates and the falling prices. They're seen as an opportunity. So it's interesting. It is changing the market, and it might change the market for you if you want to be a realtor. You know, it's all my friends who, my music major friends, they've all gotten out of music and they all become realtors. And I don't know why music majors make good realtors. I think they can't think of anything else to do. Maybe they're certainly making more money in real estate than they are in music, but that's kind of obvious. So, all right, so there's real estate. Timber. Did you know timber wasn't its own asset class? So you know what timber is? A bunch of trees. So what is it timber? Is it real estate or is it commodity? The answer is yes. It is both of those, which is part of its advantage. So timber is a commodity. So when inflation goes up, that commodity prices can go up. When housing markets are doing well, or even just general economies are doing well. But when real estate's doing well, they can, instead of processing the trees, they can sell the real estate. Maybe they own some land on a major freeway. They say, hey, we're gonna sell a few acres. So they have those choices. Timber can be for paper or for construction, hard and softwood. Timber has had good returns, and timber has been a good diversifier. And one reason for that is timber is a local market. Did y'all know Texas is a major timber state? Your friends up northeast don't think that. They think Texas is one big desert with a bunch of cacti and tumbleweeds, but East Texas is a major, I think most people in the Northeast would be shocked at how beautiful East Texas is. Y'all, any of y'all from East Texas? Just gorgeous, isn't it? Pine trees and just beautiful, beautiful. It's a little flat for me. I like hills and mountains, but just gorgeous, beautiful. A lot of trees. But you're not going to take trees in Texas and ship them to China. Trees are heavy. Putting a bunch of them on a boat is just, it's not going to work. So Texas trees tend to be driven by the South, our economy in the South. We don't ship trees to California or to Canada. It's just, and plus Canada has their own trees. I have a charity in Costa Rica, and they discover that pine trees grow really well in Costa Rica. I don't like it because I go to Costa Rica, I'm in this tropical rainforest, and suddenly I'm in Bastrop, Texas. I turn the corner and all these pine trees, but they're doing pine trees in Costa Rica. They grow faster there than they do anywhere else. And this, my last trip is the first time I saw big trucks with trees coming out of the mountain. It took them about 10, 15 years to grow them. But that's the type of market it is. It tends to be more local, so it gives you that kind of diversification. And the wonderful thing about timber is this idea of storing it on the stump. So timber is an asset that if you don't like the prices, you just leave it and it gets bigger, more valuable. There aren't too many things that do that. We do a lot of cattle loans in Costa Rica, and yeah, cows, if you don't sell them, they can get bigger, but there's a limit how big they're going to get. And also you don't want to get them too old, and so you can't just, you're not going to hold a cow. Hey, I don't like cattle prices, and let's hold this cow for another 10 years. You're probably not going to do that. Maybe for an extra year or so. But timber, yeah, you can say, hey, let's wait for 10 years, and while you're waiting, that tree's getting much bigger and more valuable. Some people are worried about disease or fire and those kind of things. Those are issues. We had a major hurricane hit Texas that wiped out a lot of the trees. But over the long term, you look at those like insects and those kind of things, it's a small fraction of the returns over the long term. Any given year, it can be big, but it's a small fraction. So HTRG, let's see if that still works, because I think they changed their website. HTRG. It's gonna be all green if I got it. I agree, whatever. All right, y'all see what I mean?
Yeah.
That's the picture they want. Because do you think timber worries about ESG? Probably the number one thing. There's probably a whole piece here on ESG somewhere. Here they argue why timber, what sets us apart. So this is one of the largest ones. They changed their name, so I'm not used to calling them Timberland Investment. They used to be, started with an H, but I can't remember now. But a large one, and they'll probably show you their portfolio as far as globally where they are. Look at that. What's the first word? Sustainable investments. Diversified by species, so hardwood, softwood. Geography. What do they mean by geography? So U.S. South, there's Texas, 32%. Canada's only 1%. New Zealand, y'all think of New Zealand as being a major timber. U.S. Pacific, that you would think of. Australia, you think of Australia as timber? Think outback, all deserts and everything, but they have trees there. U.S. lake states, Chile. Do you think of Chile as a timber place? So fairly well diversified, but it's over 50% U.S. I'm surprised New Zealand's there, but they probably bought a subsidiary or merged with some company and Australia and New Zealand. That's probably all together. So that's 40% of their book. Hardwood, wood, softwood. So interesting firm. I don't see their they have a whole button on sustainability right there. Oh, look at that. Solar right there. What does solar have to do with trees? What they don't show you is them chopping the trees down, which they've gotten really good at that. I don't know if y'all have seen. I wish it should show you a video. There's no longer these people sawing with the saw. There's this big machine that just grabs it and rips it out of the ground. It's pretty amazing. Yeah, it's they've gotten much more efficient. They don't want to show you that because it's not really conducive to their ESG argument. I don't see jobs here. So I always tell students,
You don't get rid of it.
yeah, it might be down at the very, very bottom. So there's their CEO. Looks like a happy guy. So, you know, if I were your age, I love the outdoors. I'm an outdoors person. This is an interesting career. So if you really want to, you know, jump into the deep end, if I were you, get your undergraduate in finance, go to Texas A&M, get a forestry master's. You'll be set for life. You'll be spending most of your days in blue jeans and t-shirts out in the forest. It's a very high paying job. Sounds pretty good, doesn't it? You're an outdoor kind of person. It's just, you know, so you travel. The poor guy we interviewed, he was in a suit and tie, and it's like, yeah, I hate wearing this thing. He was outdoors almost. My whole team wanted to quit and go join his firm. They were all hunters. It's like, can we come visit? We'll just bring our guns. It's like, but you could do it if you really want to specialize, and that's the advantage of this finance plus forestry. You've got it. You're set for life, and you're going to be paid well. Then you have to ask what your family thinks about you chopping down trees all the time, but they make a strong point that they're actually good for the ecology because they plant a lot of trees. They're very, you know, so you can look at their sustainability. That's a big issue for them. And how they actually do that, and in a way that, you know, trees obviously capture a lot of carbon. I didn't realize, I was reading an article, trees capture carbon, but the problem is when the tree dies, it releases all that carbon. So trees are not a permanent solution to global warming, but they are, you know, if a tree lives for 100 years, at least they did their part where they could. So I don't know. Could that be a great career? You may not make as much in that career as you would as a stock analyst or a bond analyst, but you'd be making 6 digits easily, probably $250,000, $300,000 after a few years. You may not be able to get into that 7-digit salary in this career, but hey, you're in t-shirts and blue jeans most of the day out in the forest. That may be worth it for a slightly lower pay. So timber is a very interesting. Will timber still exist 20 years from now, 30 years from now? Probably so. I don't think it's going to be replaced. I know they're doing 3D printed houses. Have y'all seen that? But they could probably do 3D printing of houses with timber as well, not just bricks and concrete, although concrete lends itself better to that. So that's timber. There are timber REITs. Weyerhaeuser. Now you've probably heard of Weyerhaeuser. You probably thought of them as a paper company. It's interesting. Some of these companies used to be REITs. I mean, used to be timber companies and paper companies. And what's happened is they've divided. So they've sold off the timber and kept the paper, or they sold off the paper and kept the timber. So Weyerhaeuser, yeah, you can see they have tickers because they're REITs. And then just the largest REITs overall, Simon Properties, you probably heard of them. Probably not the best place to invest right now. They buy a lot of malls, but they're structured as a REIT. American Towers, did you know that American Towers is a REIT? You probably don't think of as American Towers as a REIT, but what do? They have cell towers for your phones, but those cell towers are sitting where? Piece of real estate. I don't think of them as a REIT. I think of them as a tech company, but they organize themselves as a REIT for the tax reasons. And so that's just the way they're structured. So here you see there they are, American Tower. I don't think of them as a REIT, but they're huge. Look at that, 109, $110 billion company. But you haven't heard of most of these companies, have you? You have healthcare REITs, self-storage REITs, public storage. That's an interesting one, right? If you want the baby boomer, what are your parents going to do with all that junk in the garage? What should they do? They should have a garage sale. What are they going to do? They're going to spend $100 a month storing it at some place. Like I did, I finally figured out I was spending $1,000 a year to store $50 of stuff in the storage. And I finally just called the junk guys and said, come pick it up. You'll save me $1,000. But that's been pretty big. Crown Castle, you probably have heard of them. So, there's some big firms out there, but they're not massive. So you look at the largest one, 116 billion. That's big, but that's not the tech giants, 100 trillion, not the big banks, so it's big, but it's not massive like you've seen other places. All right, so think about it. I still haven't gotten any student yet to become a timber person. So one of y'all do it. Let me know how it is. I think it'd be just a wonderful life. All right, so next class, what we'll do is get into commodities and we'll finish up alternatives, and then we're going to get into the tactical side. All right, so we'll start practicing the tactical side. So I did get a volunteer, and his paper's in very good shape. So, but hopefully it's not perfect. So I'll have some stuff to pick on. He probably put some intentional things in there so I could count off just to help me out. So I'll do that so you can see what I go through. I really do grade these as if I don't grade them as a professor. I grade them as if we're in a business and I've needed this help and you're writing this paper. I'm viewing it as, are you helping me do my job? And I'm looking at it as a communication tool. And then we'll finish up alternatives, and then we'll get into the tactical allocation question. So here's the paper we're going to use. And here's how I'm going to actually look at it. I don't know if we can get these two things going because Bill Gates always makes it irritating. So let's start off by just making sure we have the data. One of the things that's great about this is report's like a month old, so I've already forgotten it. So I'm reading it as if I really don't have a clue what happened. I'm your boss. It's horrible as to think I'm your boss, but just imagine I'm your boss. I'm coming in late. I call you from, I'm leaving home and running late. I got a meeting with the CEO. I need a report on the jobs report. I've somewhat forgotten it, so I'm going to be learning from you. Now, obviously, after about the 10th paper, it's going to get a little old, but hopefully be interesting the first few at least. So there are certain numbers you have to have in your paper. I don't always go back and check every number, but I do have a little bit of a sense of what the numbers are. So, the numbers you're going to make sure you're going to have, the 526 versus 528, you might have both of those in, but this entire line you're going to have, this entire line you're going to have. You're definitely going to have participation rate in your numbers. The rest of the stuff is a little bit optional. You can obviously put this entire thing into your paper, but that doesn't count for everything. So if you put this whole thing in there, you still got to mention this number. You got to talk about markets. What did the 10-year Treasury do? It rallied that day. Boy, just think how much Treasury's up. Essentially, almost hit 4% on Tuesday, but what happened yesterday? Rally or sell-off? Because Great Britain did something that set markets up. So yesterday was a huge rally, wasn't it? Pretty massive. You're looking at me like, what are you talking about? This is your life, right? And we're talking about your life. We're talking about not to depress you. This is the next 50 years of your life, right? We're talking about here. So we almost hit 4%, but look at that. We're back down to 375. And that's with it being up 4 bips today. So obviously yesterday was a huge rally. And think about that. We've had what, 3 days of just massive, massive rallies. Just, remember 6.5%. Oh, what did I hit? Oh, that's. So. You remember these numbers, right? So this to give us some context, it has nothing to do with the student paper because you're not doing that, but. So we're up a few bips today. But what was yesterday? 26 bips. Is that a big day? That's pretty massive, isn't it? I actually added duration yesterday, so I'm kind of happy about that. I mean, on 2 days ago, I added duration here. My next buy point was 3.9. We hit 3.9, so I added some duration. So I'm happy I did that. Rallied a bunch yesterday, but then I lose a little bit today. But that's a pretty massive, the 10-year treasury. It was up over 2% yesterday. That's a good day for stocks. Really good day for bonds. So that was a massive day. But then we had 18 up, 19 up. I mean, it's just been amazing what's going on with markets. So, but on this day, the market rallied. So this seems kind of boring now because of what's happened the last few days, but it was still a fairly big day, a pretty good day for bonds. Stock market was down 1.07%. So those are the kind of numbers I'm looking for. So this 7.2 better be in your paper. What about the 2.21%? Should that be in your paper? Shouldn't be anywhere in your paper. Shouldn't even mention it. S&P down 107, and then those are the two you have to have. So these first 3 pages, there's about 10 numbers that better be in your papers. So let's see how they did here. So he does a good job with an abstract. I don't do that so much on this paper, but on the second paper, I'm real picky that you tell me what you're doing. And you should do that in this paper. You shouldn't just write a paper where you just jump into it. So you say, in this paper, I'm going to, or in this report, I'm going to. So he starts it off, this report will address. And so he says what he's going to do. Your abstract can be, so what I'm going to do, or your abstract can be a quick summary of what happened. So the employment report came out today, and generally it was positive news. However, stock markets sold off while bond markets rallied, something like that. And one, you have everything summarized in one paragraph, or you can just say, in this report, I'm going to discuss these things. You don't give any clue what's going on. So he starts off with the definition. So would you actually do this in real life? Really, you would leave all that out because your boss obviously knows what that is. I'm fine with you. I'll do it in the paper because it's good just to kind of teach yourself what this stuff is, because you want to know what this stuff is. In real life, you wouldn't do this. So I'm essentially going to ignore all of this and just jump on the next one. I want positive or negative, want to pack it anyway. Either way, I think in a report like this, the first thing you should see is there were 315,000 jobs added versus blank expected and versus prior, whatever, revised prior, whatever, I think that's the first thing you could say because that's what your boss asked for. But I don't count off on this paper for doing that. So he starts with the unemployment rate. That's fine. You normally start with the jobs and then go to unemployment. Most people do the jobs report and then do the survey and then do the household survey and the employment survey and then but either way, for some reason markets are more focused on the 315,000 than they are on the unemployment rate. So unemployment increased from 3.5 to 3.7. So look how easy some of this stuff is. 3.5, did he give me that? That was in there. Did he give the prior? Were they correct? 3.5 to 3.7, that's good. What's the only thing he's missing? The consensus. Let's see if he gets that. Controversy, making this a positive event in the labor market. This is due to the increase in unemployed persons by, now this part's a little confusing me, but it's fine. I personally don't think you should mix the jobs report with the unemployment rate because they're two different surveys. It's probably true that the adding of the 315,000 jobs had an impact on this result, but they really are two, and they can contradict each other. It is actually possible. The reason is the 315,000 is mainly a survey of really large companies, whereas the household survey is everybody, big and small companies. So it's possible you can get a distortion in those two numbers. So it's a little confusing here. I don't like the mixing of those two. That may hit them on a few points on clarity. So if I were he, I would just start off with this. The unemployed persons and unemployment, this 344 to me is a little bit confusing, but that's getting into the participation rate. But non-employment employee rose by 315. Now he says as of August. What might be a simpler way to say that? In August, all right, versus as of August. So in August, this is the August report. An increase on unemployed persons is typically a good sign. With more people entering job market, more are unemployed. So he's kind of mixing the unemployment rate with the jobs report. Previously, jobs rose by 528, which was revised to 526. Now, is the revised important? It was so small this time, it's not that big of a deal, but you still should put it in there. The reason you put it in there, historically, and this sounds like the economists are really messing up, but when the economy is doing well, the revisions are usually positive. When the economy is doing badly, the revisions are usually negative. I don't know why that is. Because you think the revisions are they just had an extra week of surveys and they revised the numbers. Maybe that is it. Maybe the economy is getting worse, so that last week was worse than the third week. But generally, so right now the revision, which way did the revision go? The prior was 528. It was originally 526, so the revision got slightly better. So I think he has this backwards, doesn't he? So he had to switch these two numbers. So it rose by 526, which was revised to 528. All right, but he does have it. So number of jobs, he got that. And he got the prior and revised. So that's good. If you don't put the revision in there, I might give you like 80% or 90%. You'll lose a few points. He might have lost a little bit because he had them switched, but that's okay. All right, so revisions and the consensus was 293. Now that one can be tricky. He does have the 293. There are other places where the consensus comes up. It depends on your source. I recommend everybody use this source. Makes my life easier, but also that is, when you see this diagram, that is the most recognized that we have. So that report is the best consensus we have. So 293. So what's the one thing we might be missing here? The expected rate. So we'll have, do y'all see that? So the expected was 3.5. Let's go to that. The unemployment measures, okay, the unemployment is expected to be 3.5. The actual is 3.7. So he does have that in there. So here's something I want y'all to try. This is on the clarity. Is can he get this sentence shorter? Now, all this is explanation. So the projected rate was surveyed to be. Does he need all of that? How might you say that? Unemployment rate came in at 3.7%, higher than prior month and above prior months 3.5%, and the consensus 3.5%. That's what I have. Versus he has that. His isn't that much wordier, but he doesn't have the consensus in there. Where was the consensus? Well, there's a consensus. So where's the prior month? The prior month was down here. So he has all of that. So that's why I say each edit, try to get it shorter and shorter and shorter. If you can say it in one sentence, don't say it in 3 sentences. I know that's tough because I know students, you're kind of been trained more papers is better than fewer pages, but that's just not true. Would your boss rather read 5 pages or 3 pages if they tell her the same amount of information? I'd much rather read 3. So if you can get it shortened down, you can get it shortened down. All right. So that looks pretty good. So what are we missing here? The private payrolls. You always want to mention private. Private payrolls were 308. Does he have the 308 in there? I'll just search it. I can't grade it the way I normally do just because I'm so I don't see the 308 in there. We can search on the word private. This is actually what I do at the end. I'll read it much more carefully. I'm reading his because we don't have much time. But I do go through it, and then if I see you're missing something, I'll go through and actually look for that word. So he talks about the pay for private, but I don't see the 308. I won't ask him because he may not want to reveal himself, but so I'm going to say 0 there, but we'll see. I don't see it. Participation rate, I know he talks about it, but does he actually give it? We'll see. So it looks like he has it here. Labor force participation increasing by 0.3% to 62.4. So 62.4, let's just make sure that sounds right to me. 62.4. So 0.3%. How could he have said it differently? He could have said 30 bips there, couldn't he? 0.3% is pretty obvious on this one. But it's still, you're talking about percent. I think 30 bips is a little clearer, but our basis points, but he could, but he does have that. So that's good. And he explains it, he discusses it. Now the question is, what else do you give me? Do you say anything about sectors? So what sectors were the big, I still think it's coming down to retail, the retail sector, it's restaurants and those kind of things, but you know, what is there? He talks a lot about wages, so he'll get a lot of credit there. And hours, does he talk? He does talk about the ISM. You could talk about the ISM, jobless claims, find something else to put some context into it. So I think he's probably going to get full credit on that. So there he does talk about the retail sector. And he does a good job of giving bigger context. That's something a lot of people like to do with employment, is try to talk about where were we in February of 2020 and where are we now? Have we fully recovered on retail? Are we fully recovered in this area, this area? That can be really interesting. You want to focus on that day, but at the same time, you can give a larger perspective. So he does a good job doing that. He talks about wages and all that. So he would probably get full credit on this one. Y'all ask me questions. You have questions as we go, but y'all see what I'm doing. And I've got 40 of y'all. And I'm going to grade this in about 20 hours. So I'm giving you each about 30 minutes. So I'm going fast. So I grade them pretty fast. You'll get your grade back. If you think I missed something, I can look at it again, but you know, I'm moving fast. That's why confusing papers with paragraphs all over the place. You talk about this and you talk about it again, and over here, it's irritating me for the grade because I got to go back and forth, try to figure it all out. And then I'm in a really bad mood and I'm grading the next student's paper. Huh?
How do we submit it? Do you submit it on Blackboard?
I'll set it up on Blackboard. Yeah. I just haven't done it yet. You'll get this as your feedback. So you'll get this, but you won't get any more than that. That's just the nature. I have 4 classes in grading, so it's just impossible. But yeah, you'll get that much feedback. All right. I really like what he does here, but he goes, this report is a well-grounded method to view the economy. Because of this, growth may be misattributed during turning points in the business cycle. That's a really great phrase. This logic remedy for this is something, I mean, this is just great. He's going to talk about ISM, but his boss didn't ask about ISM. Did he do a good job setting this up? That's really very strong. Say, hey, if we're in a bad point environment, things are turning around, we got a good report, but we may be headed let's look at some other reports that we got around this time and just see if they're consistent. That's a great way to set that up. You got to put it in your own words. I mean, this is such a great sentence. You probably want to copy that one, but the logic we made for this, and that's great writing. So he's getting, you know, a little bit of a, he's starting to do Pulitzer Prize kind of stuff, but that's really good writing there. The logic we made for this is to supplement the situation report with other releases to help diversify an economic outlook. I mean, that's my word. I hope those are his words. We'll see. You know, he's a good writer, so that's good. And then he talks about the ISM. All right. So don't just jump into the ISM because your boss is like, I didn't ask for the ISM. Why are you doing that? So he set it up very, very well. Talks about the ISM. I won't get into that, but he does a good job on the ISM. He defines it. You don't necessarily have to do that, but he does define it. So I would probably give him full credit here. Not many students talk about jobless claims. That one kind of depends if there's anything strong in that number really important. If it was blasé, not important, then you probably wouldn't talk about it. The ISM was pretty actually fairly interesting here. Last night, Alex did a really good job, the Investment Society, talking about the leading economic indicators. Those are really interesting. That may be an angle you might want to take. I don't know when the LAI came out relative to this report, but that's a really important report, and it's actually starting to show weakness now. When the LAI drops negative a couple of months, that usually means we have a recession. Not right away. It's usually 3 to 6 months in advance. So if it's starting to go negative, that could give you some strength, because employment is a lagging or coincidental indicator. LAI is a leading indicator. And so you could have a strong job report, but the economy is still doing badly, and the LAI will tell you that because it's somewhat looking in the rearview mirror. That's why the ISM is so strong. ISM is also a leading indicator. It looks to the, in fact, it's just the nature of it. They don't ask production managers, how do you feel right now? They ask them, how are you going to do in 6 months? So they actually even ask them to go out into the future. All right, so he's doing pretty well, and this one's pretty easy to fix. He may have it in there and I just missed it, but all right. So the next part is the markets. He does set up, and that's a good thing to do, is a little bit of a conclusion at the end. What does this all mean for the economy, and what does it imply for markets? You can somewhat set it up. This good news should be good news for stock markets. However, with the fear of inflation and Fed actions, maybe, you know, however you want to set it up. Market impacts, the Standard & Poor's. Now, this, you can leave it in your paper. I would definitely, in a real life situation, I wouldn't define what the S&P is. Your boss is probably going to find that insulting. Now, he's using the Bloomberg charts. It's actually pretty good to use Bloomberg charts because it's impressive for an undergraduate student to have Bloomberg charts in a paper. They don't look all that fancy and pretty, but that's fine. We're used to that, cutting and pasting from Bloomberg. You don't have to. I use the FinViz charts, which are a little fancier, but you can do Bloomberg. So there's the 107. So he does have that. He does have the closing. He does have points. That looks correct, doesn't it? Now he says open the close. I'll have to double check those. So the 1.07 is what? It's not open the close. So when you do the points, you don't want open to close. You want close the close. All right. Very, very important. This is where I confuse y'all because I give y'all so many numbers. They won't let us copy it, but We don't need volume. So the open to close was 70. The close to close was 42.59. All right, why are they so different? So you notice, so it's open, high, low, close. You notice the market closed at 39.66, but it opened at 39.44. Why did it open so strong, do you think? Probably the employment report, because it was a very positive report. So the initial reaction was very positive. That's what we call a discontinuous market. We closed at 39.66. We opened at 39.44. That's kind of frustrating because you can't do anything. It, you know, it moved against you. So you can see it's very, very important here that you're really, really clear. So he said this was open to close, but it's not. Open to close is negative 70. Open to close, that percentage change is minus 1.7%. But close to close was 1.0. Was 1.07%. Everybody see that? You can use all those numbers, but you have to have that 107 in there. The 42.59 goes with the 107. The 107 is the close on the second versus the close on the first. That's how it did for the day. All right. Everybody clear on that? I do count off if you have numbers in there that are you're not expressing right, because you don't want your boss to say, hey, yeah, the market was down 107 from open to close, and the CEO just looked at it. That's not going to look good. And what's your boss going to say when she comes back to your desk? It's like, what are you doing to me? Trying to get my job? What are you doing? So be careful on that. He shows the year to date. I think that's perfectly fine to do. He shows the decline for the month, which can be interesting as well, especially just be real clear. When you say from August, what do you mean? From August. So I think that's really confusing. Does he mean since July 31st? Does he mean since August 31st? So be real clear what dates. I would actually put the dates in there. It's down 17.66% year to date. Year to date's fine because we know what that means. And 4.7% since July 31st. Just be real clear on your dates. All right. Mainly because you don't want your boss giving out numbers and then just think the CEO says, what do you mean since August? Do you mean since July 31st? And if she doesn't know that, it's not in your paper. She's like, I have no idea. And then remember, your number one objective in your first job is make your boss look like a genius. So you got to be real clear on this, huh, Josh?
So if you put in like month to date, does month to date count the close of like, let's say like July 31st, or is it open of August 1st?
It's always off of close. So if you do month to date here, month to date would be August 31st to September 2nd, which is not much information. But if you want to say the market's, you might say, well, the market hit its high in whenever May or whatever. So you can say it's down 23% since it's high on June, whatever. That could be interesting. You can do all kinds of things. I would say if you're year to date, month to date, we assume year to date is from 12/31/2021. That's just a given. Month to date would be August 31st to September 2nd. Anything else, just give the date. So when he says from August, I would say from close on July 31st. Be just extremely explicit, whatever you're doing, and make sure the numbers are there. All right. Same thing with all of these. So he talks about NASDAQ. He talked about the graph, and that's one thing you probably want to do in this paper is talk about how the market initially was positive. Now, some have asked me, how do I explain this? And I don't know, because that's what you got to figure out. There's a couple of scenarios. The market initially really loved the report. And then as they thought about it more and they get into the details, because there's a lot of details there, they started saying, it's not really all that good, or maybe it's good news is bad news because the Fed's going to have to really raise rates or whatever. It's inflationary. Or some said, well, some news came out of Russia here. Maybe that's it. What's the right answer? I don't know. You've got to figure that out. Is it possible we don't know? Yeah, because the market comes down because there's millions of people out there trading stocks. You don't know what they're all thinking and why they're doing it. So we don't really know. We're just guessing. You'll see articles that will actually tell you explicitly why that happened. They don't know either, but they're just pretending like they're omniscient, but they don't know. They're making it up because that's what journalists can do. They just make it up. So no one really knows. If you don't know, then don't say it came down because Russia made this announcement on pipeline. You could put both in there. You could say the market declined dramatically going into lunchtime, either because they were rethinking what the report told them, or maybe some news came out of Russia, or maybe both, or whatever. But sentiment definitely declined. Then it was flat for a while, and then there was some negative sentiment there, but at least recovered. So you can talk about, it was down X% from its highs of the day, but did recover point something percent off of its lows. You can talk about the highs and lows in the day. So you definitely want to give some sense of what the market was thinking throughout the day. There are times when it sells off and people are pretty sure why. Maybe Jerome Powell came out and said something, or maybe some company reported something, or there's all different reasons why that may be. So we don't know what the right answer is. The key is you put what you think. You can use words, and I like to see words, in my opinion, I think, I believe, according to so-and-so. That's fine. I like that a lot better than saying the market dropped because, when you don't really know that's the reason, right? So don't express your opinions as fact. All right. So on the stock market, he'd probably get a few points out because he had the wrong, but he's going to fix those right before he put that in intentionally. So I have something to show y'all, but he's probably already fixed it, but you want to be real clear there. The bond market is where most people lose their points. Let's see how you did here. He explains the 10-year. You don't need to do that, but he does. Here, you got to be real careful. I'm not really sure what that chart is. So make sure, I'm not real sure what that chart is, because we know interest rates are down and this is showing it going up. So is that the 10-year treasury price? Exactly what that is. So this looks like the yield here, doesn't it? The 10-year yields dropped for an open to close. Again, he's talking open to close. You want to do close to close. Remember what the close to close was, 7.2. You can talk open to close if you want to. Open to close is essentially what you're saying is where the market was at initial reaction to the report versus where it closed. That's perfectly fine to talk about, but make sure you always talk about close to close. That's going to be important in paper 2 as well. You always talk close to close. So he's going to lose some points from not having the 7.2 in there. And one thing on something like this, if on the S&P 500, it's not a big deal. We know this is the price. But on bonds, you have to be real explicit. Are you talking price or yields? So make that really clear in your charts. Okay. So I can tell this is yield because I know what yields did. I'm not real sure what this is. This could be price. There's no reason to show price on treasuries because we don't actually know which treasury we're talking about, because there's multiple 10-year treasuries out there. So he'll lose some points in there. One thing to make real clear on is tell me both the actual yields in numbers and tell me price in words. So I would start it off on treasuries rallied as yields dropped. Okay, tell me the price, or treasury sold off or rallied. They rallied on that day, so rallied. So you don't need to tell me the change in price. We don't talk about the percentage change in price on treasuries, but tell me whether they're up or down. This is fine to show what year to date is done. Year to date again is going to be the yield at the end of the day on September 2nd versus 12/31. So anytime you do use 12/30 year to date, you're off of 12/31 the previous year. So there you might get a little bit, that's one thing, and that's pretty common on bonds. Some students get no credit on bonds because all their numbers are wrong. I don't know what to do if every single number is wrong. His 10 basis points is probably right. So something around. In other markets, he talked about NASDAQ. He talks about inflation. Has a few other things in here. He probably should have a couple other, he talks about the VIX. So part of what I do here, and this is the most subjective part, is I look at the quality of the discussion and then which ones you picked and how well it makes sense in there. So if you're talking about the government bond yields in the Netherlands, yeah, that's another market. But did they actually move because of the U.S. job report, or is something else happening? If I can't see the connection why you're talking about, so if you find something pretty obscure, I don't know. The U.S. dollar is really, really important. It wasn't so important on that day, but it's been really, really important here recently. So that's pretty important. Gold might be there. The VIX is interesting. Sometimes, not always. You know, a lot of people talk about NASDAQ, and probably your boss probably does have some curiosity about NASDAQ because the tech stocks have really been driving the markets down this year. So and the tech stocks have been really worried about interest rates rising. Small cap stocks, you can talk about them. They're worried about recessions. So if they don't do as badly as NASDAQ, that probably means we're more worried about interest rates rising. Now, is it possible NASDAQ sells off because they're worried about interest rates rising when interest rates actually fell? That's possible. Those are two different markets. So there's other ways to go. So here, I don't know what we do here. It depends. I'll guess 90, but I don't know there. On the clarity, so he had that killer paragraph. So I'm going to give him some points on that. That was really good. I think he could really work on clarity and just making it much smoother and crisper, you know, especially on the employment side. It's kind of jumping around. So in clarity, I don't know, about 85, but he can certainly work on that. Critical thinking, I don't know. I'm just going to guess. I didn't really read his paper, so I can't really say. So on clarity, it's organized. It's not redundant. You have it in a really logical way. You have good transitions, so he gets a lot of points for his transition. You have good conclusions, good starts, those kind of things. The critical thinking is, do you understand what you're talking about? Are you making connections and you're doing that? So where can you really help? You know, right there, that adds a point, 2 points. Really right here is the biggest thing. So, you know, and some of these, if he fixes the bonds, that probably is going to add some points. So he probably can get this to an A pretty easily with just an hour or two of extra work. He's not missing much. So he's way ahead of the game because he's got, you know, tomorrow to work on it. So I'm probably grading a little harder, just to give him some incentive to work on it. But y'all see how I view this. And that just took me 20 something minutes, you know, so it takes me quite a while to grade these papers, but I'm not talking like this when I'm grading your paper. Using my cat's up. My cat, you know, you should never have a touch screen when you have a cat because they like to lean against the screen and suddenly your paper gets shut down. I have to.
Oh.
So, all right. Questions, comments on that?
Is this rubric on Blackboard?
No, it's implied in the job description. I'm not a huge, I do use rubrics. I'm not a huge rubric because when you get your jobs, guess how many rubrics your bosses give you? Somewhere around 0. And they won't give you nearly as much information I've already given you. Your boss is going to say, I'll be here there in 30 minutes. I need a paper on the jobs report. That's I've given you a lot more than that, but that's all she's going to tell you. So, you know, so rubrics are good, but I think we overuse rubrics in college, especially your junior and senior years, because you don't get those in practice. So, other questions? I'm trying to make this as real life as possible. This is what you're expected to do as a college student. Okay, don't lose the easy points. Make sure the 315's in there, the 3.5, 3.5, 3.7 in there. Those are easy points. Don't lose those. And then try to put something in there that just blows me away. Try to find something. It's like, man, I'm going to put this in. He never would have thought about that. Good quotes are really good. And there's some good investors out there that have really great quotes. Some market that really reacted that you think would be interesting. All right, so we're working through question 1 here. We're going to finish up the last thing on real assets. So we did real estate. Talk about REITs. They're really not real estate. They're really more Stocks, small cap stocks. We talked about timber, which is one of my favorite asset classes. And so the next one is commodities. There are people who have commodities and real estate as their own asset class, not under alternatives. At USAA, real estate was its own class. It wasn't alternatives. For USA, alternatives were private equity and those kind of things. So if you're putting 15, 20% into an asset, it's probably not an alternative. Commodities for most people are still an alternative asset class. Most people don't have 5, 10% in commodities. They're just too volatile. They're hard to buy. They're not quite as easy. You can use futures to buy them, and we'll talk about that later, but still you got to hire someone to do those type of trades. So, all right. So when we look at commodities, we break them into energy, agriculture, and metals. Those are the main categories. Let's look at FinViz. Because FinViz does a good job of showing their results. I really love FinViz. I don't know if y'all started using it or not. Yeah, that's not what I wanted. Sorry. I really love this chart, which doesn't look so great today. Now, last night, Juan Carlos showed this, but he showed it, and I didn't realize until he showed that you can actually change the dates. So here's year to date. Isn't that pretty cool? So don't forget about this. This would look really great. You could have done this for September 2nd if you've been paying attention, but you probably can't get it now. I probably should have told you. I should probably start putting in this. Sometimes I think I do put it in the PowerPoint. I don't think I did this time. I don't remember. Did I? I don't think I did. Yeah, sometimes I do, but I didn't do it. So you probably can't get to it. And it would probably be a pretty massive undertaking to create this yourself. So year to date, you've got a few meds. You got energy, obviously, up, Exxon a bunch. Microsoft down 28, Google down 30, Meta, they can't even put the number out there, 57%. Some healthcare, which is just kind of all over the place, but pretty bad year, isn't it? So that's a really cool chart. You could use that in a lot of papers and be really, really impressive. But I'm going to go to the futures. So here's the futures. Up here are stocks. So we're not talking, that's not commodities. There's the VIX. That's where I got that VIX. So then we get into the commodities. Crude oil, both WTI, West Texas, and Brent. And look how different they are. This is a really strange thing that's happened the last few years where Brent and WTI really gotten off from each other. Gasoline, that one obviously has been pretty amazing. Look at that. Biden's terrible. Biden's great. You know, he's like, well, just in time for the elections. We'll see if that cures it. I love, you know, on Facebook and other places, it's like they talk like this is going to last forever. And then when it does that, you never see those posts again, both sides of the political fence. We call that confirmation bias. We see something that confirms our egos, and man, we tout it, and then when it goes away, we're like it never existed, and it just makes us feel so smart. So yeah, Biden caused that, but did he cause that? My guess is he didn't do either one of these, but you can debate that, but don't put it in your paper. So gasoline has definitely come back. I've been shocked at how much gasoline has come down. Because boy, it was moving fast. Even in San Antonio, we hit $4, didn't we? But we never got the 5. Did we get close to 5? Yeah, I never buy gasoline, so I don't know. But yeah, it seemed like it was getting up there, and then suddenly it's back down really, really fast. San Antonio tends to be cheaper than most other places. Boy, I wish I could shut that down. Natural gas. Oh my word, natural gas was at $2 for the longest time. Just two. And then look at that, almost up to $10. And then this is interesting because whose natural gas is this? Natural gas in the US looks a lot different than in Europe. So, you know, it's Europe wishes they had these prices, but they can't actually come and buy it because natural gas, unless you liquefy it, it's hard to get it across the ocean. So natural gas, that's energy, ethanol. And I think they were pulling back on ethanol, weren't they? Because it was causing food prices to go up so much. I don't know all the changes in that, but ethanol. So there's your energies. I don't know why ethanol is up today. Maybe wheat prices are up. We'll look and see. You got your bonds. That's not a commodity. Then you get into your agriculture. So cocoa, cotton, orange juice, coffee. We do a lot of coffee in Costa Rica. We're hoping that price is up, so they're doing pretty well there. That's good. They sell a lot of coffee, bananas, passion fruit. So coffee's up quite a bit. That's great. We got a lot of microloans on coffee. I don't drink coffee, so they say their coffee is really good. I had no idea because I've never drunk their coffee. Lumber, we just talked about timber. How's timber doing? Looks the same as gasoline. You would think lumber would have been up a bunch because of housing shortages and house construction and all of that. Is there a link between lumber and mortgage rates? Timber people will say it's not as strong as you think. There's a lot of people think timber is all about houses, house construction, but they say there's more to it than that. But I mean, it sure looks like mortgage rates rising. You see timber coming down, but anyway, you can get those prices. Might be a good time to do timber if prices come down that much. Sugar. So there's your foods. And then, boy, there's the most irritating thing about their site is these pop-ups. And boy, they have a zillion of them. And then metals. Gold, we know gold's is not done as well as you would think in a year of inflation. So with all this inflation, it's down. But one thing you can do, and this is pretty interesting, you can do this on Bloomberg, bring in gold, bring in the 10-year treasury yield, bring in the US dollar, bring in inflation, and correlate them all together, but over time, do a rolling correlation and you'll see gold reacts different ways. Probably the US dollar is probably the strongest part of gold. Gold really is a protection against a weak dollar. So, because you buy gold in dollars, and so gold can be really interesting, but it's kind of amazing how badly, because people buy gold to protect from inflation and they're like, whoa, that didn't really work out this year. So, silver. Now, silver is interesting. Gold is primarily a precious metal. We don't generally put gold in the cars, in the manufacturing. Silver is both a precious metal and a production metal. So it can react to inflation and the dollar. It can also react to recessions and manufacturing. So silver is a little bit of a tricky, but I would still, bring silver and gold in and correlate the two of them. Have y'all done a lot of correlations? In Bloomberg, you can do it right there in Bloomberg. Bloomberg has something called CORR, and you can bring up all kinds of stuff and do correlations just like that without having to bring all the data in. It does it all for you. It's pretty cool. So you might try that. This is the kind of stuff that really helps you into an interview. I mean, think about it. They're talking to all these Harvard grads that don't know anything about finance because all they do is textbooks, and then they come interview you and they say, how you doing? What do you think about markets? Oh, I was just looking at a correlation between gold, silver, and dollar, and I thought it was interesting. You just destroyed those Harvard grads. They don't do anything like that. Why? Because their professors didn't ask them to do it. That's how you get points in an interview. I was doing this saying, oh, you mean for a class? No, I was just curious. Curiosity is the number one thing they want. If you're doing stuff out of curiosity, boy, you're going to win the interview. Trust me. That's why William has done so well. William does all that stuff outside of class just because of pure curiosity, and it just won them over. They said, hey, yeah, we want you to work for us. Platinum, copper is essentially, copper is not a precious metal in it, is it? Do y'all have copper jewelry? I don't know. I don't know anything about jewelry. So copper is primary production metal. Palladium, I don't know anything about that. So there's your metals. You get into more agriculture with your meats and your grains. Wheat is actually down today, so you use that for ethanol. Oats, canola. So there's already commodities. Down here are currencies. We're not going to really talk currencies in here. And what you'll notice is, if I can get rid of this stupid thing here, what you'll notice is the most volatile one is really interesting. The VIX is up a bunch today, but usually the ones on the outside are the metals, the agriculture, the energy. The ones in the middle are usually the stock markets and the bond markets. So commodities are much, much more volatile than stock markets and bond markets, but they also diversify. So soybean oils are up 2.7%, but cotton's down 3.66%. So you get diversification within the commodities themselves. So the S&P is down here at the bottom now because it's moving so much, but you don't normally, you usually see the S&P and NASDAQ right in the middle. But even then, you're gonna definitely see a lot of the commodities on the outside. And who knows why these are down? They're very, it depends. There might be a flood somewhere. We just saw Florida's going through something horrible. You would think that what would you think that would do to orange juice without looking at it? Should make it go up. I don't know if that's the case. I don't remember what it said. So orange juice is up. That makes sense. Florida is a major producer of orange juice. Or Brazil has a major catastrophe. That's probably going to hit sugar prices pretty heavily. Mexico has a crisis. What's going to happen to guacamole? Or what is guacamole? What is it? Avocados. Yeah, I felt so stupid in Costa Rica. The guy had this tree, and how do you say avocado in Spanish? Yeah, that's what he said. It was like, oh, we don't have those in San Antonio. I didn't recognize the word, and it was like, that's how bad my Spanish is. And he's thinking, wow, you don't have guacamole in San Antonio. How sad. So yeah, I mean, they're a major producer. We're seeing what Ukraine's doing, the wheat prices, and Russia. There's certain things that you get kind of surprised where that concentration is. So that can have a huge impact on one thing. You can specialize in this. This could be your whole career, or just doing nothing but trading lean hogs. That could be your entire career. Why? Because you have to know it in a really, really deep way that most people don't understand. Who produces it? We've seen on hogs that China had the not mad cow disease, I guess mad pig. I forgot the name of that, where they had to destroy millions of pigs. Well, that has a huge impact on prices because pork is a major meat. We had Oprah Winfrey having a show about mad cow disease and how terrible cows were. That caused prices to come down, and then the cattle farmers, I think, essentially sued her for bad information. But there's things that can hit one of these without hitting others. I don't know why coffee's down today or why lumber's down today. We can kind of guess. Why is cocoa up today? Who knows? I don't know who even produces cocoa. They have some of that in Costa Rica. I was kind of disappointed that the cocoa bean doesn't smell like chocolate at all. It's kind of boring. I was expecting this really rich aroma, but it doesn't. But they do some there, but I don't know the major producers of cocoa. But if you became a specialist in this area, you would know all of that. You know exactly who produces what, where, why, what's going on in those countries. So it can be a specialization. Now, there are some ETFs and mutual funds you can invest in that do commodities, but you have to be really, really careful. All right, here's the GSCI. You notice that it is 62% energy. That's a really heavy allocation. So if you buy the GSCI, you're essentially buying an energy fund. That's really, really critical to understand, because the other major one is the AIG one. So it's only 30% energy. So which of these would you have rather have had this year? So if you do this one, you're heavily into energy. So that one I would have just done horribly in 2020. It would have just been an absolute disaster and should do really, really well this year. This one's only 31% energy. It probably still would have done poorly in 2020, but probably not doing as well this year. It's only 31% as the time I did this. Why did I decide that? It's, how do you decide your weights on this? And that's the theoretical thing. They got to sit down and figure out, we're going to look at the market weight around the world. How much is energy you just try to add up the revenues or whatever reduction, how exactly you come to those weights. Each one of these indices will have a methodology, and you can go and read the methodology and see exactly how they come up with the weights. That by itself is actually pretty interesting, because then you see the issue they're dealing with. These are not easy things to do, but very, very different. Now, you could go out there and just buy an ETF that's just energy, but you got to be real careful. It's a big difference between buying energy companies and buying oil and gas. So they're not always the same. 2008 was a good example. 2008, gold was up. Gold stocks were down. One of the mutual funds under me was our gold fund. We had a precious metals fund. He was actually negative for the year, and your gold prices are up. So his customers, what are you doing to me? You should be up. Gold is up. Well, firms that produce gold are companies. They're having debt problems, and maybe they're hedging the gold prices. There are all kind of things going up. They don't just move up with oil. Now, we've seen this year, Exxon's up a bunch when oil prices are up. That's probably the normal situation, but you can't always be sure of that. It's possible Exxon has hedged its oil prices. If they hedge oil prices and they shoot up, they're not going to do as well as oil done. Or if they hedge their prices and oil falls, they won't do as badly. So you got to be real careful with these ETFs. Are the ETFs actually buying the commodity? Are they investing in companies that have the commodity? Those are two very different things. The other thing you have to be really, really careful of, this was a huge issue a few years ago, is how are they getting you the commodities? Are they using futures markets? Are they using swap markets? And the big issue has been a lot of these are using the swaps market, because the swap market's a lot easier to deal with. You got to be real careful with the swaps. When you do swaps, you're picking up counterparty risk, which means the other side of that swap could be Lehman Brothers, could be Merrill Lynch, it could be JP Morgan. That'd be pretty good. So there is some fear of some of these firms. If we have a major banking crisis, you're going to think you made a lot of money, and you're not going to make money because the bank on the other side of the swap is just going insolvent. So there's several issues with these things. Don't just go out and buy these things assuming they're really, really great without doing some research, especially if it's a firm you don't know really, really well. You're probably better off sticking with the big players like the BlackRocks. BlackRock would probably bail out its firm if it made a mistake like that. It probably would step in and fix it. So just be careful. Could you do commodities yourself? Yeah, you can go out into the futures market. You got to get your broker set up and do it correctly. You better know what you're doing. We'll talk about futures later. You can do options on these markets as well. So there are other ways to get into these markets, but they're incredibly volatile. You can just see that, very, very volatile assets. They're more volatile than the stock market. So I wouldn't put all my money into oil and just hope for the best, because oil did what? Fell from 100 and something down to 20, and then went back up to 100 and something. Now it's back down to 8. You think the stock market is volatile. You go from 100 to 20, that's a volatile price. That's very, very volatile. So, be careful. Don't put so much of your money into something unless you do a little research. Definitely do historical analysis and just compare the standard deviations of these funds to the S&P 500 just to get a sense of the volatility. Are these good inflation hedges? That's the other thing you should test. Don't assume they're good inflation hedges. Go to Bloomberg and bring in these mutual funds and just do a correlation between them and inflation. And just see, are they actually an inflation hedge? If inflation's up, are they up? Inflation's down, are they down? I like doing rolling correlations. So the overall correlation might be 0.6, but there may be times when it's negative 0.2 and times where it's positive 0.8. I like to know that as well. So, do some extra research. That's really easy to do yourself. Get this data in. I'm not a commodity investor. That's just not my thing. I've spoken to commodity traders. They're very weird people, unusual people. If you want to do this, get into it early. You could kind of circular go into it. So go work for Valero. And if you work for Valero, you just beg them to go through the trade desk. You could go from the Valero trade desk to working on the investment side as a commodities trader. You could definitely do that. So if you go to Valero, work on their trade desk, you're really in this market. They're going to be dealing in the futures market. And so you're going to get that kind of experience. scary jobs. Traders are incredibly type A, extreme type A personality people. I would have been disaster out of college. I was scared to death. They would just eat me alive out of college. But if you're bold and confident and you can handle, a lot of expletives all day long, and they're telling you how stupid you are, and they're really intense people. They have to be, because they're willing and dealing all day long. They got to be aggressive. They can't be passive. But if you want to do that, they're very high paying jobs. They're very specialized. If you do those kind of jobs, yeah, you make a lot of money, but well, your doctor is probably going to be wondering what's wrong with you. Your stress levels are going to be really high. Wonderful thing about this job is you get in at 6 a.m. and you're essentially done by noon. You just go home. You may come in at 5. You got to be there when the market's open, which a lot of times it's 24/7. So you have to come in really early, but you're going to do your trades in the morning and then you're done and you're out of there. So you get a lot of free time in the afternoons. But they're cool jobs. So I do, if you can get a chance, if you're a really strong type A personality, got a lot of confidence, trade desk are a great experience early in your career. They're very stressful, but you learn, the learning curve is incredibly steep. You feel so stupid for about 3 weeks and then you start getting the hang of it. So yeah, if you want to go for it, go for it. All right, other assets that we're not going to do are other real assets that are extremely specialized: artwork, collectible, bitcoins, maybe. I don't know these markets at all. Classic cars, those kind of things. I had a former student in this class that he did coins, not bitcoins, but actual coins. That's his specialty. I see on Facebook he'll put a new coin out there that he's found. That's his expertise. There's other places. There's a guy in Costa Rica. He does beetles. Did you know we trade in beetles? So he goes out in Costa Rica, he goes out in the jungle, and he puts 2 beetles together and creates a new beetle that's never existed before, and he'll sell them for $500-$600. Pretty amazing. He wanted for us to invest like $10,000 to build something, but the problem was if he dies, everything dies with him. The university came to meet with him, and he's like, "I'm not telling you anything." It's like, it's all in his head. It's like, we're not going to give you $10,000 and then you die tomorrow. But yeah, I mean, that's a specialization. I don't know anything about beetles. He knows them really well. He showed us some of the beetles. He had really cool looking things. I don't know what anybody spends $500 for them, but really cool looking things. So, you can definitely get into here. This is really old. I don't know the passion asset returns. I don't know if I can find it. Yeah, I don't know what's going to come up if I type the word passion either. So, I'll put it out there so markets can tell y'all. Let's see returns that comes up. I don't know if it's going to tell us. This one says wine is the top performing. Why is wine doing so well this year? I would have thought wine would have done really well in 2020. But you can find these. So this is 2021. So fine wine's up 137%. Why? I have no idea. Coins are up. Or I'm sorry, now that's 10 years. Oh, that's not it. Wine's up 16%. Watches are up 16%. Watches. Art, rare whiskey. I don't know why it's rare whiskey. And then coins are up 9%. Why? Who knows? They're all very specialized. So the problem with this asset class is the trading costs. Trades are extremely expensive. You want to go sell a Rembrandt, it's going to cost you a fortune to sell a Rembrandt. It's going to cost you thousands and thousands of dollars. It's not like going to your broker and buying Apple stock. It just doesn't work like that. It's very, very liquid, probably even less liquid than real estate. It's just a really, really tough market. Not an area I'm an expert in, but at the time this article I found, this is what was going on. There's another index there. I should look that one up. They say up 90%. That's since 2005. I don't know what year it stopped because I didn't put the date that I brought this, but you can see it's all over the place. So artwork was down. There was a time where artwork was really doing well because people in China were buying a lot of artwork. And then President Xi came out and says, "Hey guys, don't be buying stuff that makes you look rich. this kind of conspicuous consumption. Don't do that. Looks bad. We are a communist country after all. And then prices just tanked. There's all these billionaires in China buying this stuff. And then suddenly they're told, you know, you're being unpatriotic buying this stuff. Just one guy, President Xi, says something and markets just tank. So it's a very dangerous market. Classic cars were a good place to be. They weren't up to 245 per year, but that's over the time. So if you annualize that, maybe it's 20% or something. So specialized market. Could you make this your career? I guess, but I doubt. I mean, unless you have a background in this, you're probably not going to learn it from scratch. All right. So you don't need to talk about these others on the exam. You're not going to be interviewing on those areas at all. No one does this. BlackRock might do something like that, but probably not too much. All right, then the last one I'm going to do on alternatives are venture capital. Another term for this that you should have in your notes, because venture capital really is not the right term. It should be private equity. If y'all heard that term, private equity. So venture capital is part of the private equity. So private equity are firms that you can invest in that aren't on the public markets. You can't trade their stocks. You have to buy them directly. Venture capital are firms that are private, but are just starting out. They're brand new firms. So venture capital, brand new firms. Private equity can be big companies. So Dell Computer went private, and they've come back out again public. So Dell Computer, massive firm. Michael Dell did, I don't know if he did a management buyout or LBO, but he took Dell private, fixed it, and they came out public again. So that's a massive firm. Burger King went private and then came back out public. But venture capital is the small companies that just start off, and you have these investors that do these venture funds. They'll go out and raise $400 million, and you become an investor in that. You say, yeah, I'll commit $30 million. You don't give them $30 million, you commit $30 million, and over time they ask you for money. Say we have a $10 million funding next week, and you do the wire transfer to them, and then they do 15 million or whatever. And then over time, you get these reports that don't really tell you much because it's all guesswork, but and it's really rare. I mean, it's really infrequent. So once a quarter, you get a report where they tell you what they think these firms are worth, but they don't really know. These are startup firms. There's no public information, but they give you, they give you what they think the firm might be worth. At USAA, I inherited USAA's private equity portfolio, and literally, the lady who I took it over from, she walked over literally with a shoebox and said, "Here's all my private equity stuff." It wasn't on the computer, it wasn't documented, it was just a big box, and no one cared about it because it was so small. I think at that time we had like $500 million in private equity, which is just nothing. It wasn't even 0.5% of our assets, so no one cared. Like, well, you got $500 million sitting there, let me at least put it in Excel. So I loaded everything in Excel so you at least watch it. It was kind of, seemed like a waste of time. I'm spending all this time on this small portfolio, but I felt like someone should at least look at it. And we had I think about 10 or 15 partnerships we were invested in. And then after about 10 years, the firms inside the fund started going public, an IPO, the initial public offering. And so I got these stocks, and it was my job to decide what to do with the stocks. So a firm started, like Charles Rivers, one of our companies. That's a pretty good fund. Medtronics was one of our companies. So a venture capital fund started Medtronics or funded them. After 10 years, Medtronic went public. So suddenly I had all these shares of Medtronic stocks. I went out and did a study to try to figure out when's the best point to sell these. So we sell them day one. So we wait a couple of weeks, we wait a year. So I finally figured out, just looking historically, kind of a good time to sell them. And so that's when we sold them. And now I think their portfolio is almost down to zero. They just lost interest in it. But it's just not a big part of USA's business. There are some people like the big pension plans, like CalPERS. They have significant money. Probably Harvard and Yale probably have significant money in these type of investments. There are some investors that have 10, 15, 20% in private equity. So some people do a lot of it, but if you do a lot of it, you have to hire specialized people to do this, because this is a very specialized field. Now, this can be your whole career. Unfortunately, private equity doesn't hire UTSA. So you have to go get a graduate degree from Harvard or UT Austin or some other school. They tend to be in places like Boston. Austin, and they tend to hire from one university because they're small firms. But you could do this. We have a few UTSA students that are doing this, but they didn't start here. We have one in Austin right now who's working for private equity and doing really, really well. So, you know, you could make that your career, but it's hard to get into coming from UTSA. All right, we'll finish this one up next class and talk about the J curves. So.